Chapter. We're talking real money.
Welcome to Talking Real Money. We're here every Saturday answering your questions, your calls, coming up with some comments about what's going on today. I'm Tom Cock. Tom McDonald is still plugging everything in, and he'll be along here in just a moment. I guarantee it. I think in the old days, he used to call this technical difficulties, but for me, it would be. For him, not so much. So, all right. Anyway, the show really, while we are the hosts, is about you, your questions, your concerns, the things you want to know about, so you can kind of put money in its place. You know, that's one of the themes of Talking Real Money is, I know we spend a lot of time on it, but it really shouldn't be at the core of your being. I know a lot of people that get up every morning and check all their bank accounts. They check all their investment accounts. They look at everything and try and figure out what they should do that day. And that is, honestly, as someone who really does do this every day, that is no way to live. So we want to help you avoid that. We want to help you build a future with less worry and less concern about money. How do you do that? Well, one way is to call us and chat. Pretty easy. 855-935-8255. 855-935-TALK. That is, that's a toll-free number. And your calls always come first. So let them rip. But, you know, one of the things that we've noticed lately, speaking of ripping, is Warren Buffett. Warren Buffett, the Oracle of Omaha, the guy who runs Berkshire Hathaway. He's been selling a lot of stock, piling up a lot of cash. And people that watch these things on a day-by-day basis are sort of scratching their heads because Warren has been the definition of a long-term buy-and-hold investor. I mean, he has done this for decades, and he has publicly stated, buy great companies and keep them for a long time. Now, he has a slight advantage that many of them he gets involved in the management of, but he's been making some moves lately that have been a little bit of a head scratcher. Got to say, he's cut his stake in Apple from $175 billion to $70 billion. That's a pretty significant sell-off. It still does represent Apple, a quarter of the Berkshire $266 billion equity portfolio. He's also sold, Bank of America. Yeah, I've been selling a lot of that stock. He sold 235 million shares of Bank of America, BAC. That's created this huge, as I mentioned, cash pile. It's remarkable. It's $320 billion, Don, that he's built up.
That's enough money to buy like 25 of the biggest companies in the world.
It's crazy. So when I read this, though, and I think he's kind of older, right? Warren Buffett?
Yeah, he's like 900 years old?
Okay. So maybe he's figured out that
because he's got a lot of money. He's figured out how to live longer.
He's figured out that you can take it with you. Maybe he's cashing out his chips to be able to pile it up for the next world. That's just my take when I read this. I think, maybe that's the thing. I don't know.
Yeah, and you know, the thing is that Warren Buffett is different than us, though. This is the thing. Warren Buffett, we have to stop comparing how we invest with how he invests. We can't buy entire companies. We just can't do it. We don't have that kind of money. So we just buy a bunch of companies in aggregate. And so what Warren is saying right now is, I have standards for the companies I buy, and they are not meeting my standards, but he doesn't have a lot of options, because when he buys a company, one, his presence causes the price to rise.
He's all in.
The other thing, exactly, he's going to be all in. The other problem is he has all kinds of regulatory requirements if he owns big chunks of companies. So he's not, when we compare our style of investing to his, it's really mistaken. It's a huge mistake, because if you buy the whole market in good times and bad, even in those times when Warren was more heavily in cash, waiting long enough made you money.
And we'll continue on this, but I think when people hear this in a general sense, they think market's at a record high, stocks have gone up a lot, maybe I should be taking some of my winnings off the table. That's what they think, I believe.
Yeah, and that is a problem, and I'll tell you why in just a minute. 855-935-TALK is our number.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hey, I'm Don. That's Tom. We're talking real money. What a coincidence. 855-935-TALK is the telephone number that you use to get to us. It's so very easy, and it's available to you this week. Now, bear in mind, next week you will not be able to call us.
That show is done. It's in the can. It's ready to go, right?
We'll be here, but we won't be live because both of us will be traveling at the same time.
It's a new show, but we will not be on the air at that time.
So if you want to call, it's this weekend or it's after Thanksgiving. 855-935-TALK, 855-935-8255. So has Warren Buffett become a market timer?
I'm going to say no, but it does sound a little bit with the market now. The market's worth $58 trillion. The S&P 500.
It sounds like a lot of money. It
does sound like a lot. The S&P 500 is up 24.1% year to date. There's all kinds of indicators that suggest that things are too expensive when you look at them, like stocks are way out over their skis or whatever expression you wanted to use. But does that mean anything?
Well, the only thing I can think that it means is that part of the market might be overpriced. Part. But only part.
I can think of a couple of stocks.
Yeah. And the part of the market that we're talking about is the part that's the most popular. As a matter of fact, if you look at the international markets, if you look at the developed or the developing markets, the emerging markets out there, if you look at small cap and value stocks, these have all been laggards over the past several years, while the big growth, big name stocks have powered almost all of the return in the stock market. And those are the kind of stocks that Warren Buffett has tended to own. He's had a lot of Apple or Bank of America.
Well, he was a value guy, and then he kind of, I don't know. It seems like he abandoned some of that a few years ago, especially with Apple. You can't call that a value stock.
Apple hasn't been a value stock since Steve Jobs was alive.
Yeah, in a long time, decade plus. So, now, no. Do I think
should you be doing what he's doing? No.
Yeah, good question. No, you shouldn't be. Well, okay. With the one possible suggestion that you do always rebalance when things get out of whack. That's what I think. I think he's doing that here, right?
I think so. And here's the other thing is that we know, and Tom particularly knows this because he looks at your portfolios like every day. We know that you could probably stand a bit of proper balance to begin with. I'd be willing to bet that most of you, because they've been hot, have most of your portfolio in the S&P 500. I betcha.
Oh, it's
the vast majority of your portfolio.
I bet you're going to win. I mean, that's because, again,
maybe it's not a matter of timing, but it's a matter of starting to do the right thing with the money. It's like, well, I haven't wanted to move it because it's doing so well. Okay, well, good for you. Good for you. You got lucky. But maybe if you don't have 10% of your equity portfolio in small cap, if you don't have 10% of your equity portfolio in value, or maybe 15, maybe even 20, and if you don't have 30% of your portfolio in international stock minimum,
and if you have, and this is more and more portfolios I see, 20% of your portfolio is made up by 5 companies. Because if you own the S&P 500, that's 20%. I mean, 20% of your money's in 5 stocks. Companies. That is not diversification. So, you might want to clean that up.
Maybe the answer is to actually get diversified. My guess is you're not. And you should take this as not a timing signal. I should get out of the market and I'll wait to get back in. Because here's the problem with doing that. Let's assume for a minute that we're at the top right now. And it's going to go down from here. I'm not saying it's going to happen. This is hypothetical. This is a thought experiment. Let's say it's going to go down from here. You get out. Whoa, good for you. When will you get back in? You will not know.
I'll get back in when it hits the bottom.
When it feels better. When I know it's at the bottom. We know you don't know when the bottom is. Actually, the top often feels a little bit easier to predict.
Mm-hmm.
Bottoms are hard because bottoms are they're so depressing. Nobody wants to invest when they're depressed.
Yeah. We've been there, seen that, talked to many of you. So I will say if Warren is right, if he's right, I'm glad that the old guys are going to win one because after what happened to the old guy last night in the ring, I'd like to see an old guy have a victory. So
why did anyone waste their time on that, Tom?
I watched it.
Why?
Did. Well, first of all, it was on at a reasonable hour here on the West Coast. For you would have to, be awake in the middle of the night.
Yeah, but again.
Number two, it's the curiosity. It's a oddity. Here's a nearly 60-year-old man in the ring with somebody,
28
his age. Yeah, 27, 28 years old. So.
No, it's not a third his age. It's half his age.
Okay, whatever.
Half his age.
I heard 20 and 60 in there.
This is like
a third along the way.
This is the dumbest thing. And it turned out to be an utter disaster, which made me feel even better because I was sitting around going,
watching and it started blipping. And I was, of course, blaming our internet provider thinking, oh, thanks. I live in the middle of nowhere. No. The internet doesn't work. And no,
that was Netflix.
Yeah, it was Netflix because they had 100 million people or something tuned in for it.
They just didn't. There aren't enough servers in the world to handle that kind of flow to one feed.
Yeah. And for those of you who have been, outside of the realm of news for the last, 2 months, we're talking about Mike Tyson's fight last night. Who's he? I don't even remember the name of the guy who's fighting. I don't even know who that is.
Jake Paul.
My daughter knew him, but I didn't know him.
His claim to fame is he's a YouTube influencer.
Oh, okay. Well, that's something. Everybody's got to be known for something, I guess. So, way to go, Jake.
Yeah. I mean,
now you're known for beating up old men. So well done.
Okay. I have to admit, I'm gonna come clean. I'm gonna come clean with all of you. I hate boxing as a sport.
Well, it's a brutal.
I just hate it as a sport.
I know it is.
It just doesn't seem sporting to beat someone to a bloody pulp on the floor. Literally bloody pulp.
Yeah. Well, you should have seen the fight right before it. The women, they were literally. I mean, it was.
I just have no interest.
Viewing,
I don't have any. I'll watch football because at least those guys go in and there's a sport.
Oh, you can't see their injuries there, right?
Right, and they're in uniforms and they've got padding and they've got helmets and you hit.
By the way, there's
if
a concussion
you punch someone in the head
too. If you hadn't
yeah, but if you punch someone in the head in football,
doesn't do a whole much.
You're going to break your hand.
Yeah, it hurts you more than them. Yeah,
which seems fair.
Yeah.
855-935-TALK is our phone number, 855-935-8255. And Gene, welcome to Talking Real Money.
Well, I see you two guys are getting in the ring. Who should have put my money on?
Yeah.
We're not bettors either.
We're not bettors either.
No.
That's, yeah.
All right. I don't know if you have pencils and papers there, but I have a couple figures to go over. All right. First of all, I have a net worth of $7 million,
okay,
plus a $600,000 house that's paid for. The problem I have, good, I guess, is I have too much money.
Okay.
But
I can give you off the air. I can give you my wiring instructions. If I don't like to give them on the air, but that's fine. That's not a problem.
My wife and I have no pensions.
Mm-hmm.
We live off of about $45,000 of taxable to 85% figure on Social Security. My portfolio generates between $70,000 and $80,000 in dividends and interest a year. Another $70,000 or $80,000 in
cap gains,
capital gains.
Okay, and hold that thought right there, Gene, and we'll continue taking our notes here after we do this.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
To help Gene out with the terrible problem he has, poor guy. Too much money. Way too much money. Got about $7 million in assets, and coming in, you've got about $195,000 in taxable income per my math here during the break. Is that about right?
Plus another $100,000 required minimum distributions between my wife and I. Were both above 73.
So $295 altogether.
Right.
Okay.
Now the problem is I'd say about $2.5 million of this is in taxable investments, basically mutual funds. Mm-hmm. But they've been there so long that some people say, well, why don't you just start getting into ETFs? So I figured if I liquidated to $2.5 million, I'd have a $600,000 capital gain.
Yeah.
Because some of the money has been in those funds since 1995.
Yeah. No, you probably don't want to do that.
Okay, but you're step 80 for me, not step 2. What's the purpose of all this money if you're not going to spend it?
Right. That's the best question.
I have $1 million. Part of this whole math, I have $1 million of my taxable assets in CDs.
Okay, now let me ask you a question, though. Yeah,
so I don't have a mortgage.
What about that $2.5 million? Let's start with that. The $2.5 million that's in a taxable account. If you died tomorrow, what would happen to that money? Where would it go? What would it do?
My wife will go on a worldwide trip.
Okay.
Okay, but
after her, where will that go?
Well, wouldn't yours? I mean,
No, you're right. Mine
wants to go while I'm still. Mine wants to go while I'm still alive.
But
so,
is there a purpose for this money after your lives? Is it going to children, or is it going to charity, or what's going to happen to it?
Well, that's part of it too. I have a son and a daughter, and they're both in their late 40s. They got $2. One just entered college, and I'm there in the background, going to help out with college if it's need to, 100%. Mm-hmm. And I'm thinking, well, if I sell this stuff now, I'm going to get a capital gain hit.
No. And that's why I'm saying. That's why I was asking this question, Gene, because there's no reason for you to sell money that's in decent investments right now to move it to ETFs. That's just goofy advice because it incurs a big tax hit. If you leave this money, if you don't need it, and if it's going to go to your kids, your wife, and then to your kids, then the wonderful thing about the tax law is that the cost basis steps up to whatever it's worth at your death. So don't mess with it. It's providing you with enough income.
Here's another idea. If you're charitably inclined, you could do a donor advised fund with the money that's in the mutual funds that would allow you to reduce your tax bill. You could also do QCD with the RMD, so the money goes directly to a charity there, so that you don't have to pay tax on that. Other than
how
that,
much
there's
of your money, how much of that income of that $295 before tax do you use in a year? Do you guys spend that?
Well, let's put it this way: I only have no pension, $45,000 of Social Security. My adjusted gross income last tax year was $288.
Mm-hmm. Okay.
He's saying out of that, though, how much do you really need?
I'm paying almost $60,000 just in federal tax.
Okay, I think we're focused too much on the tax, though. The question is, how much of that $288,000 after? Okay, they take the 60 out, 228. How much of that do you live on? All of that during the course of the year? Do you spend that amount?
I think I spend about $100,000 a year plus $60,000 to pay the taxes.
Okay, then that goes back to Tom's point of the qualified charitable distributions. If you are charitable, if you plan to be charitable with this money after your passing, then it might be a very good idea to set up a qualified charitable distribution. That'll take that $100K a year in RMDs and eliminate the tax liability.
Right. That, and then as I said, also with the taxable portfolio, you could set up a donor advised fund, move some of those highly appreciated assets into that would allow you to still have control of the money, but
give you the deduction.
You'd get a tax break to do that. So there'd be some ways to do this. But
you are at the point in life where you have more than enough assets. You don't need all the income. You've got to figure out both an estate plan, a tax plan, and a financial plan, which says you need a really good advisor. 855-935-TALK. Call us.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
We're going all over the place. Let's see, from Florida to Seattle over there to D.C. with Gene, and then, Massachusetts with Bob. Hey, Bob, welcome to Talking Real Money.
Hi, how you doing?
We're doing well. Thanks for calling.
I'm calling about my brother-in-law and his wife asked me to look at their portfolio. Great people, I'm happy to do it. They're 67 and 64. Both are still working. Their portfolios, mostly in IRAs, total about $440,000.
Okay.
Their advisors have them in relatively expensive funds, weighted expense ratios of 69 basis points and 82 basis points.
Sorry. Yeah.
But the portfolio is almost entirely U.S. and not well diversified there.
I'm betting it's all American funds.
Other issues with the almost entirely.
Shocker there. Wow. Thanks, Bob. Yeah.
My main concern is that their equity fixed income ratio is about 90-10.
Oh.
And remember, they're in their mid-60s. I think the logic is the feeling that the portfolio may not be adequate and that they need to take extra risk, even though they're that close to retirement.
How long until they're going to quit, though? How much longer are they willing to work?
In the next 1 to 3 years, I believe.
Then they're too.
And the other one may want to work longer. But, even if the portfolio is inadequate at that age, is being 90-10 an okay thing to do?
No,
generally
because
speaking, no.
Yeah, because if you need to pull on it in the next year or two and the market's down considerably, which it definitely could be, and if you're 90% in stocks, no, you're going to want to have more fixed income at that point.
I would suggest that, and this is not a pitch, but have them go over to talkingrealmoney.com, take the risk quiz. That will help them determine, because it's not just age, it's also inclination. The other thing that has to be a part of that, though, is determining how much money this portfolio is going to need to generate for them in retirement, in addition to their Social Security and any other sources of income they might have.
Yeah, I've asked them to think about how much they really need for the portfolio to generate, because even with the 4% guideline, between that and Social Security, they'll be seeing about $80,000 a year, which is probably going to be enough for them.
Which is then that tells you everything you should know. Why would you drive at 90 miles an hour when 60 will get you there? I wouldn't do it.
Exactly. This is telling you that their portfolio, this is telling you, and this should be telling a lot of our listeners the same thing, that when you get one of these people who holds themselves out to be a financial advisor but is really a commissioned salesperson, and I'm guessing this person is with that company that has somebody in every tiny town in America because they sell American funds like they were going out of style, and builds a portfolio that is not well diversified and that does not talk to their clients about their risk profile or risk tolerance, that a huge disservice has been done to them while the broker has made a lot of money off of them.
Yeah, I like what Don said. I would go back, figure out what income they're going to need from the portfolio that will be added to Social Security and other sources of fixed income. Then once I knew that number, you could work backwards. You could say, okay, so if you retire with $500,000, that will supply you. Then you could continue to work backwards and say, with that in mind, you don't need to be so aggressive. You could be far more moderate, not get the ups and downs, and not potentially face a sequence of return risk, which could be harsh if you retire soon and the market is down. That could be ugly.
I mean, they should probably have like a 60-40, maybe 50-50 portfolio.
Hard to know. Yeah.
It could be so simple. It could be as simple as VT and BND. That simple, conceivably, which would be a net expense ratio of less than 0.1.
And the other aggressive part, the risk they're taking, is having most of their securities in one type of stock.
That
is risky too, because those are the ones that have gone up the fastest. What we want to do is balance that between many asset classes so that you sort of the yin and the yang with all this, whatever is ahead. You're not focused so much on one part of the market. But yes, you're really doing a great service there as the brother-in-law, I'd say, for sure.
Absolutely.
Well, I think I've been listening to you guys too long because what you're saying is exactly what I've been telling them. So I really appreciate all you've done. Thanks so much.
Well, we appreciate what you're doing, too. Thank you so much, and I wish them the best. But it's time for a major change. And I know this is probably a good friend or a family member or a close associate, but this is business. They need to terminate this relationship and start investing the way they should for their needs and wants. 855-935.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
While we're here to talk about real money, we really like to answer your questions more than anything else. So, which is why we plug the number a lot on our Saturday show where we do take live calls. 855-935-TALK is that number. We are on the radio in the Seattle area on News Radio, on Northwest News Radio from noon to 2 Pacific time. That's 3 to 5 Eastern. And you can call us. You can also, though, ask us questions at talkingrealmoney.com. Going to the contact form. You can speak them or you type them, and then Tom gets this piece of paper.
Yeah.
That's right there in his hand.
You go to a printer and it prints it out.
I don't understand. Let me just share a little anecdote.
You don't print anything. I know you don't.
Let me share a little. My wife is like, she gets emails from people. The only computer she has she has an iPad, but she never uses it. What she uses as her computer is her iPhone.
Yeah.
That is all she uses. So she has no idea how to print from an iPhone. So
which
she's
you
always
can do, by the way. It's not that hard.
Which you can do, but she just sends them to me and wants them printed. And I go,
oh, good Lord.
Why do you want them printed?
No.
Because I need paper. Oh, you should talk.
I don't make my wife print my stuff. I print my own stuff.
Okay, but you print it and you want it on paper.
Yes, I do. I do like it.
What is that, like sheepskin hanging over your face?
Let's not go there. By the way, for those of you playing along at home today, I'm taking anything to put it in the washer. So no limitations. We're not doing like whites only or colors.
You're just mixing them all together.
We're throwing it in there.
This is the wild
cold water.
load.
It'll be good. Yeah.
It's the wild card load.
Before we go to the question, I got another thought around Bob's question too. Because this is an important thing to think about.
Oh, Bob in Mass, yes. With the nice guy helping his family, yes.
Where it might be tight with the money, right? With the savings, right? Here's something to think about. How long are you willing to work? Many people, they don't think about the fact that if I go one more year, it makes a lot of difference because I'm pulling on it later. It gets more chance to not just to grow, but also to add to it. So, for what it's worth.
And something else, Bob, that I thought of this too after the fact is one of our favorite ways to take income from a portfolio is in the flexible withdrawal method.
Yeah.
So you said 4%, but if they had a 50-50 portfolio or a 60-40 and they took 5% per year, they would have some years where they did very, very well and had nice big checks. And as Tom says, they're going to Hawaii. They'd have other years when they're not vacationing. But
they come to our place during the winter.
The lake house.
It's got waterfront. Kind of cold, but
Well, in the summer, the 3 weeks of summer, you can go boating.
No, I was talking about now. Come now.
Oh, yeah.
Go now.
Anybody can go now. 855-935-TALK is our number, but Tom has a question that came in from TalkingRealMoney.com.
This came in from Jenny in Indianola, Indiana.
Florida. Oh, Indianola, Indiana. There's an Indianola, Florida, too.
Exactly. Says, my husband and I retired in January of this year. That's awesome. Many thanks to your podcast to help us achieve that goal. Well, and then she added, couldn't have done it without you. That is very kind. Our rollover IRAs are at Vanguard. We've been taking 4% distributions from his individual retirement account this year. I turn 59 and a half next month. My rollover IRA is substantially larger than his. Should we change to pull distributions from my IRA next year? Is there any reason to take distribution from one or another account, split distributions, alternate years, or whatever? So,
well,
apparently I have an answer, but
apparently we drove you from the workforce or something. It sounded like it was our fault.
Oh, they did so well that they can afford.
Yeah, they retired. We drove them from the workforce. All right. So, the
question really is: she has a bigger retirement account than he does. Where should the money come from to live on?
Well, he's older than you, apparently.
She doesn't say how old he was.
But she's just turning 59 and a half, so she's just becoming eligible to tap it.
Well, she can tap it anytime, but you're going to pay a 10% penalty.
Yeah,
if you do. Yeah.
So, okay, go. I'm going to say you take his, but go ahead.
No, I'm going to say you balance it between the two because you want to. This will work later when you get into RMDs.
Yeah, but that's why I'm saying go after his more than after hers, because if his draws down faster than hers, she's got a lot more time to RMDs. As a matter of fact, at her age, RMD should be what?
75.
75.
Yeah, 75.
So, wow. I mean, she has a very, very long time, much longer for those dollars to grow before they have to be withdrawn. I'm assuming he's older. I think I'm right.
Yeah.
If he's substantially older, a few years older, several years older, then I would just, if you're doing fine on his, drain his.
I want to make sure she's clear on one thing though, because I'm feeling this a little bit from her, is about the amount you have to take out as an RMD. Once the participant reaches the required age, and it is a bit of a moving target, as Don just said, because those of you born after 1960 can wait until you're 75. Mm-hmm. Those of us older than that have to take them at 73, whatever. But it's not a household number. That's the number. I'm getting that a little bit from her here. This is per individual.
Per person, yeah. Right,
so there's you don't get to put things together and then say, where's it come from? Each person has to take the required amount out.
Right. But she has a long time before she gets there.
You're
and
right.
In his case, the fact that he's taking already, and if it's sufficient for their needs, then I don't see any reason to switch. I'd let hers accrue longer, tax deferred.
And if her household is like mine, where everything I have is ours, everything she has is hers,
it doesn't
then
sound
it works
like
out.
that. It doesn't sound like that's her family.
My family or her family?
No, her family. I know it's your family. It doesn't sound
and
like
it's yours too. So what are you kidding?
I know, but I don't know if she's listening or not, so I'm trying to be
You're going to be real quiet upstairs.
Less critical.
Yeah, let's see if we can get along, because you and I will be doing the show from there in a couple weeks. So let's keep things calm until then. What do you say?
I got your mic right here. Here you go.
Is that my mic? I have to hold it over the side there?
No, I have a stand right here.
Okay. We did it once before. I think it was fun.
Yeah.
Enjoyed it.
This is a lovely Neumann BCM 705 dynamic mic.
Boy, everybody knows how great that is. So give me a break.
I mean, not an Electro Voice. Mine's an Electro Voice. They're great mics. This is a great mic.
I got the same thing. It doesn't mean
it's the RE20. It's a great mic.
Anyway, Jenny, thank you for your question.
I'm a mic fiend. I love
microphones.
Yes,
you do know your mics. That's true.
I do love me microphones.
Mike Tyson.
But here's the funny thing. I do the show on an RE20. I do my voice work on an Austrian Audio OC818. I used to do it on a Sennheiser MKH416. That's
okay. I got to ask, how do you, before buying these things, how do you know what's going to sound different on a different microphone? How would you have any idea?
I have no idea. So
would you go online and test it or something?
I check reviews. Now, what everybody told me when I got started was that I needed a U87, which is the Neumann state-of-the-art mic.
I don't think survived World War II, if I remember. I think it got. I think Neumann? It went down. Yeah. No, the U87.
Do you know that Neumann made?
They
made all the mics for like the Nazi party. Neumann did.
I was making a joke there, but let's not bring the Nazis into it. What do you say?
Well, you said funny. It was a World War II
all
joke.
Right, reference. Okay, fair enough.
But anyway, I think
so. You don't even like that one anymore.
Well, it sounds good, but the other ones just sound better. So I think I may be getting rid of my Neumann.
Yeah. All right.
But I'm going to keep my Sennheiser.
I think it's so important to know that.
Do you have any other questions? We can take another one after the break. Do you have a short one?
Yeah, I got some shorties.
Okay,
sure.
So what we'll do is we'll take a break here.
Okay.
We'll just get it out of the way. And then when we come back, we're going to take a quick question, and then we're going to end this hour.
We're also going to tell you about something pretty exciting that's now available, too, by the way.
There's something available for a limited time?
Well, probably, yeah.
Kind of, yeah. So our number, 855-935-TALK, and we'll do this, and then we'll come back and do that, which is what we do here on this show we call Talking Real Money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
See, that was relatively painless. And now, let's go to another little quick question before we end the hour.
Rich from Hot Springs Village, Arkansas writes, we keep hearing that Social Security will begin paying reduced benefits on or about 2035. I plan to start collecting Social Security after that date. Does the Social Security calculator factor all that in? If not, then is it right to plan for a 20% decline in what the calculator is telling me?
Oh, nobody except the news media is saying that, and people who have a political agenda of some sort. Nobody knows what is going to happen for sure.
I do know.
To Social Security.
For sure. It's not going to go down. It will not go down.
You do not know that for sure. You do not know that.
Because it's such an integral part of the world, society, etc.
You strongly
you're right.
believe.
I can't guarantee it, but I'm pretty close.
No, you can't even come close to guaranteeing it,
all right.
But you can be highly confident, as I am.
Don't factor that into your calculations.
No. Factor in what we know.
Yeah.
What we know is that Social Security has been sacrosanct since it began in the 1930s.
That's right.
It is unlikely that it will change. Therefore, why would Social Security factor that into the numbers except to scare the living daylights out of people?
Yeah.
Which is what it would do.
A 20%
right now,
cut would be very harsh to many people in this country. Many.
And I would suggest, just from a political standpoint, that those who believe that Social Security should remain as is, get in touch with their congresspeople and let them know how strongly you believe that.
And that you prefer not to wait until the day before to solve it. Okay, so don't factor that in.
But it is an uncomfortable problem for Congress, because none of us like increased taxes, and that's what it will take to make Social Security. I believe there will be some combination
of that and some change to the benefits.
Changing of the age, maybe.
Age, there'll be something there. But,
think about it. Think about it for a minute. What's the full retirement age these days is rising to 67.
67, correct.
You're sick. I'm 68 years old.
Whoa.
I do not feel. Well, you're 67 almost.
No, I'm only 66, dude.
I'm
way younger than you.
2 months.
I get back in the ring. I'm feeling good.
Yeah, you're not going to be boxing anybody. Anyway, now you distracted me.
You distracted me. I'm supposed to be promoting what we're doing in February, but we're
going to get to that in a minute. But I want to tell people that 67 is young. Maybe it should be 70. If that could solve
There's
the problem.
the argument that if you're carrying bricks around your contract, whatever, that's 67, 8 young. Anyway,
they
we're not going to get into all
to
that.
carry stuff.
Yeah, we're not going to get into that.
What
we will get into is inviting you to the 11th RetireMeet. It's now, you can now buy tickets, and yes, this I can say with certainty, it will sell out. It's February 8th in Bellevue, RetireMeet.com. That I can guarantee.
You are setting a terrible precedent on this show by pretending to predict the future. Because you're pretending to predict the future.
I see. I'm not pretending. So
yes, you are.
Our early bird tickets available now. Don will be speaking. I will be speaking. Paul Merriman will be speaking. We have Joe from Stacking Benjamins speaking. We got people talking about Social Security, Medicare, everything you need to know about retirement at RetireMeet. Saturday, February 8th. Go to RetireMeet.com to register right now. Do not wait.
That's RetireMeet.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.